All right, let's jump right in. Something really weird is happening in the markets, and we need to talk about it. For years, people have been lumping gold and Bitcoin together, right? But now, all of a sudden, they're heading in completely opposite directions. So, we're going to break down what's going on. Okay, get this. On one side, you have gold, the old school, tried and true store of value, just rocketing to all-time highs. And on the other side, Bitcoin, the supposed digital gold, has been in a free fall, down almost 40% from its recent peak. One is doing exactly what you'd expect a safe haven to do, and the other, well, it's doing the exact opposite. And that really brings us to the $1 million, or maybe the 21 million Bitcoin question. What on earth happened to the whole digital gold story? How did an asset that was pitched as a safe harbor end up acting just like another risky tech stock? To really get what's happening now, we've got to rewind a bit. We need to look at the original pitch and understand exactly why Bitcoin got that catchy and very powerful nickname in the first place. Now, this is where it gets really interesting. If you just look at them on paper, you'd think they were twins. The whole argument was, hey, both of these things are super scarce, no government can control them, and they're both a great way to protect yourself from inflation and central banks printing money like there's no tomorrow. And you know what? It was a really compelling story. So the bedrock of this whole argument was this idea of a fixed supply. I mean, think about it. You can't just snap your fingers and create more gold. And you absolutely, positively cannot create more than 21 million Bitcoin. In a world where governments were firing up the money printers, this digital scarcity felt like its killer feature. It was like a modern-day gold rush, but with code. But that was the theory. And in early 2026, the market decided to put that theory to a very, very brutal test. And let's just say the results were not what the digital gold fans were hoping for. And this chart, wow, it just lays it all out crystal clear. State Street Global Advisors looked at what happens during big market meltdowns. And guess what? Gold did its job. It consistently went up, giving investors a safe place to hide. Bitcoin, on the other hand, it plummeted, losing over 35% on average. It wasn't a safe harbor. It was caught in the middle of the storm. Yeah, instead of being this unique asset that zigs when everything else zags, Bitcoin has been moving in almost perfect lockstep with the riskiest stocks out there. A correlation of 0.80 with the NASDAQ is just incredibly high. It basically means when high-flying tech stocks get crushed, Bitcoin gets crushed right alongside them. That is the literal opposite of a safe haven. And this quote from a top researcher at NYD just hits the nail on the head. He's saying that when investors get scared, what they call a risk-off environment, they're not running to Bitcoin for safety. No, they're selling it. They're using it to get cash. It's not a bunker to hide in. It's become an ATM you hit up when you need emergency funds. So the big question is why? Why is this happening? To get the real answer, you have to look past the price charts and dig into the deep structural differences between how the gold and Bitcoin markets actually work. Okay, let's follow the money. Who's actually buying this stuff? For gold, you have the biggest, most stable players in the world, central banks, scooping it up by the ton. That creates a huge, steady demand and basically puts a floor under the price. Meanwhile, in the Bitcoin corner, the big new players, the ETF investors, were running for the exits, pulling over $1.6 billion out in just 1 month. The big money is going into totally different directions. And it's not just who's buying, it's what makes the price move. Gold prices react to the classic stuff, geopolitical drama, changes in interest rates. Bitcoin, though, is a different beast entirely. It acts like what some people call a liquidity sponge. When central banks turn on the money hose and flood the system with cash, Bitcoin's price soaks it all up. But when they tighten the taps, the sponge dries out and the price falls. And then there's this, the volatility. I mean, we all know Bitcoin is volatile, but when you see it side by side with gold, it's just staggering. According to Macquarie Bank, it's nearly 6 times more volatile. Look, that kind of movement is thrilling if you're a trader, but it's absolutely terrifying if you're trying to preserve your wealth. It makes it a terrible safe haven. So, does all this mean the digital gold story was just wrong? That Bitcoin has failed? Well, maybe not. A new and, frankly, a much smarter idea is starting to emerge. It suggests that maybe we've been asking the wrong question the whole time. It's called the barbell strategy, and the concept is actually pretty simple. Instead of trying to find one asset that does a little bit of everything, you go to the extremes. You load up one end of your portfolio with super safe defensive stuff and the Other end with super high-risk, high-growth potential stuff. You avoid the mushy middle. And this is where it gets really cool. In this strategy, gold and Bitcoin stop being competitors and actually become teammates. Gold is your defensive anchor, your goalie. It's your left-tail hedge that protects you from a once-in-a-decade market crash. Bitcoin is your star striker. It's your right-tail hedge that gives you a shot at those mind-blowing lottery ticket returns if everything goes right. And the research shows that putting them together can actually give you better performance with less painful losses than just owning Bitcoin alone. So all of this brings us to one last really important thought that kind of flips this whole debate on its head. It's not about which one is better, it's about what each asset truly is.
So, what if we've been looking at this all wrong? Maybe Bitcoin's wild ride isn't the story of a failed digital gold. What if it's the story of the market finally discovering Bitcoin's true identity? Not as a new kind of gold, but as a completely new kind of asset, a high-risk, high-growth, pure-play bet on the future of technology. And honestly, understanding that difference might be one of the most important things for any investor to figure out over the next few years.